Welcome to the Trading Ledger. This is Season 1, start to finish, in one place. 10 lessons, in order, what Forex trading actually is, pips, lot sizes, reading candlesticks, support and resistance, choosing a broker, setting up a demo account, drawing trend lines, placing your first trade, and the psychology behind all of it. Each one builds on the last, so if you're brand new, start from the beginning. If you just need a refresher, the chapters below will take you straight to any lesson. Let's get into it. Every single day, over $7 trillion is traded in the Forex market. That's not a yearly figure, that's not monthly, that's every single day. To put that in perspective, the New York Stock Exchange, one of the most famous markets in the world, trades around $25 billion a day. The Forex market is roughly 280 times larger, and yet, most people have never even heard of it. In this video, I'm going to break down exactly what Forex trading is, how it works, who's involved, and whether it's something you, as a complete beginner, can actually learn. No jargon, no assumptions, just a clear, simple explanation from the ground up. Let's get into it. Forex stands for foreign exchange. At its most basic level, Forex is simply the process of converting one currency into another. And here's the thing, you've probably already done Forex trading without even realizing it. If you've ever been on holiday abroad and swapped your pounds for euros or your dollars for Thai baht at the airport, that was a Forex transaction. The difference between that and what we're talking about here is scale and intent. When you exchange money at the airport, you're doing it to spend it. When traders participate in the Forex market, they're doing it to make a profit by buying a currency when it's cheap and selling it when it's worth more. So the Forex market is simply a global marketplace where currencies are bought and sold 24 hours a day, 5 days a week, across every time zone in the world. There's no central building, no single stock exchange. It's a decentralized network of banks, institutions, brokers, and individual traders, all connected electronically. Now here's where it gets interesting. In Forex, you never just buy or sell a single currency on its own. You always trade currencies in pairs. Let me explain why. If you want to buy euros, you have to buy them with something. Maybe you're using US dollars to buy euros. That transaction, dollars for euros, creates what's called a currency pair. In this case, EUR/USD. The first currency in the pair is called the base currency. That's the one you're buying. The second is called the quote currency. That's the one you're using to pay for it. So EUR/USD tells you how many US dollars does it cost to buy 1 euro. If EUR/USD is trading at 1.10, that means 1 euro costs $1.10. There are hundreds of currency pairs available to trade, but most beginners focus on what are called the major pairs. These are the most traded, most liquid, and generally easiest to start with. EUR/USD, Euro versus US dollar. GBP/USD, British pound versus US dollar. USD/JPY, US dollar versus Japanese yen. USD/CHF, US dollar versus Swiss franc. These pairs make up the bulk of daily Forex volume, which means they're easy to enter and exit, an important thing when you're starting out. This is the question everyone wants answered, so let's be straight about it. In Forex, you make money by correctly predicting which direction a currency pair's price will move. If you think the euro is going to get stronger against the dollar, you buy EUR/USD. If the price goes up and you sell it higher than where you bought it, you make a profit. If you think the euro is going to get weaker, you can actually sell EUR/USD first and buy it back later at a lower price. This is called going short, and it's one of the things that makes Forex unique. You can profit in both rising and falling markets. Now, and this is important, the price movements in Forex are often tiny. We're talking about fractions of a cent. This is where the concept of a pip comes in. A pip is the smallest standard unit of price movement in Forex. We'll cover pips in much more detail in the next video, but for now just know, small movements, when multiplied by large trade sizes, can add up to meaningful profits or losses. Which brings us to the topic of leverage, another concept we'll explore in depth soon. Leverage allows you to control a large position with a small amount of money. It amplifies both your gains and your losses, so it must be used carefully. For now, just understand the core idea: buy low, sell high, or sell high, buy low. That's the fundamental goal. The Forex market has several types of participants, and understanding them gives you useful context. Central banks, like the Bank of England or the US Federal Reserve, are some of the biggest players. They buy and sell currencies to influence their country's economy and control inflation. When a central bank makes a major announcement, it can move the entire market. Commercial banks, large institutions like Barclays or JP Morgan, trade massive volumes of currency every day, both for clients and on their own accounts. Corporations, multinational companies need to exchange currencies constantly. An American company paying suppliers in Japan needs to convert dollars to yen regularly. Hedge funds and investment firms, professional traders managing billions in capital. And then there's retail traders, that's people like you and me trading through an online broker from a laptop or phone. Retail traders make up a smaller percentage of overall volume, but advances in technology have made it accessible to virtually anyone with an internet connection and a few £100 or dollars to start with. Let's be honest for a moment, because a lot of Forex content online isn't. Forex trading is not a get-rich-quick scheme. Anyone telling you otherwise is either naive or trying to sell you something. The statistics are sobering. A significant portion of retail traders lose money, particularly in the early stages. The reasons are almost always the same: no education, no strategy, and poor risk management. But here's the other side of that coin. The traders who do succeed have something in common too. They treated it seriously. They invested time in learning. They practiced on demo accounts before risking real money. They managed their risk carefully and didn't blow up their accounts chasing big wins. Forex is a skill. Like any skill, driving, coding, playing an instrument, it takes time to learn and practice to develop, but it can be learned. This channel exists to give you that foundation, step by step, in plain English. No fluff, no get-rich promises, just solid education. Forex is the global market for buying and selling currencies, always traded in pairs like EUR/USD. Profit comes from predicting price direction, and the market runs 24 hours a day, 5 days a week. Next time, pips. If this helped, like, subscribe, and tell me what got you into Forex. See you next lesson. If you've spent even 5 minutes looking at Forex content online, you've heard the word pip. I made 50 pips today. The market moved 200 pips in an hour. I only risked 20 pips on that trade. But nobody ever stops to explain what a pip actually is. At least not in a way that makes sense to a beginner. So that's exactly what we're doing today. By the end of this video, you'll know what a pip is, how to calculate pip value, and why it matters so much to every single trade you'll ever place. Let's go. The word pip stands for percentage in point, or sometimes price interest point. Don't worry too much about what it stands for. What matters is what it means. A pip is the smallest standard unit of price movement in a currency pair. For most currency pairs, like the euro versus the US dollar, the British pound versus the US dollar, or the euro versus the British pound, a pip is the movement of 1 unit in the 4th decimal place. Let's make that concrete. Say the euro versus the US dollar is currently priced at 1.1050. If the price moves up to 1.1051, that 1 unit change in the 4th decimal place is 1 pip. If it moves from 1.1050 to 1.1080, that's a movement of 30 pips. Simple enough, right? Now here's where it gets slightly more interesting. You'll often see Forex prices quoted to 5 decimal places like 1.10505. That 5th decimal place is called a pipette, or a fractional pip. It's 1/10 of a pip, and it just allows brokers to give you a more precise price. So when you see a 5 decimal price, the pip is still the 4th decimal place. The 5th is just extra precision. Now, there is one important exception you need to know about, and that's currency pairs involving the Japanese yen. For yen pairs, like the US dollar versus the yen, or the euro versus the yen, the pip is the movement of 1 unit in the 2nd decimal place, not the 4th. So if the US dollar versus the yen moves from 145.50 to 145.51, that's 1 pip. Why the difference? It comes down to the relative value of the yen. 1 yen is worth much less than $1 or €1. So the pricing structure is different. The rule is simple. most pairs, pip is the fourth decimal place. Yen pairs, pip is the second decimal place. Burn that into your memory and you're good. Here's the key question. If a pip is such a tiny movement, why does anyone care? 1 pip on its own, for a small trade, might only be worth a few cents. But Forex traders rarely trade tiny amounts. They trade in standardized sizes called lots, and the lot size you trade determines exactly how much each pip is worth in real money. There are 3 standard lot sizes you'll encounter. A standard lot is 100,000 units, worth around $10 per pip. A mini lot is 10,000 units, worth around $1 per pip. A micro lot is 1,000 units, worth around 10 cents per pip. So let's put that in perspective. Say you open a trade on the euro versus the US dollar with a standard lot, and the price moves 50 pips in your favor. 50 pips times $10 per pip equals $500 profit. Now flip that. If the market moved 50 pips against you on that same trade, that's a $500 loss. Suddenly those tiny decimal movements look a lot more significant, don't they? This is why understanding pips is so fundamental. Every time you plan a trade, you need to know, how many pips am I risking, and what is each pip worth in my account currency? Let's walk through how pip value is actually calculated. Don't worry, it's straightforward. The formula is pip value equals 1 pip divided by the exchange rate, multiplied by lot size. Let's use a real example. Say you're trading the euro versus the US dollar at a price of 1.1050 with a standard lot of 100,000 units. 1 pip equals 0.0001. So, pip value equals 0.0001 divided by 1.1050 times 100,000. Pip value equals 0.00009049 times 100,000. Pip value equals approximately $9.05 per pip. Now, the good news is you almost never need to do this calculation manually. Every broker platform and most Forex websites have a pip calculator built in. You just enter the pair, lot size, and your account currency, and it tells you instantly. But understanding why the calculation works the way it does gives you a massive advantage, because you'll always be able to sense check whether a trade makes sense before you enter it. This is probably the most important part of this video, and it's something many beginners overlook entirely. Pips are the language of risk management in Forex. When professional traders decide how much to risk on a trade, they don't think in pounds or dollars first, they think in pips. Here's what that looks like in practice. A trader might say, I'm going to set my stop loss at 30 pips below my entry. A stop loss is an automatic instruction that closes your trade if the price moves against you by a certain amount, protecting you from losing more than you planned. So if you're trading the euro versus the US dollar with a mini lot, and your stop loss is 30 pips, 30 pips times $1 per pip equals $30 maximum loss on that trade. Now you know your risk before you even enter. That's powerful. Compare that to a beginner who just opens a trade with no stop loss, no pip calculation, and no idea how much they could lose. When the market moves against them, they panic, hold on hoping it reverses, and end up losing far more than they intended. Pips give you precision, and precision gives you control. We'll go much deeper into risk management in a dedicated video later in this series, but start thinking about pips not just as price movements, but as your unit of risk. Let's recap everything we covered today. A pip is the smallest standard unit of price movement in Forex. For most pairs, it's the fourth decimal place, for example, 1.1050 to 1.1051. For yen pairs, it's the second decimal place, for example, 145.50 to 145.51. The fifth decimal place is called a pipette, just extra precision. Pip value depends on lot size. Standard lot is around $10 per pip, mini lot around $1 per pip, micro lot around 10 cents per pip. Use a pip calculator on your broker platform to get exact values. Pips are the foundation of risk management. Always know your pip risk before entering a trade. Now you know what a pip is, and more importantly, you understand why it matters. In the next video, we're going to talk about lot sizes in detail, what they are, how to choose the right one, and how lot size connects to your account balance and risk. It builds directly on what we covered today, so make sure you're subscribed so you don't miss it. If this video helped you, leave a like. It takes 2 seconds and it genuinely helps more beginners find this content. And drop a comment below what confused you most about pips before watching this. I'd love to know, and it helps me make better videos for you. See you in the next lesson. Here's a mistake almost every beginner makes. They open their first Forex trade, they pick the right direction, the market goes exactly where they predicted, and they still barely make any money. Or worse, they get the direction right, but they size their trade so large that a tiny move against them wiped out half their account before the market turned back around. Both of these problems come down to the same thing: not understanding lot sizes and position sizing. This is one of the most practical, most important topics in all of Forex trading, and it's one that most beginner courses skip over too quickly. Not today. By the end of this video, you'll know exactly what lot sizes are, how to choose the right one, and how to size every position so you never risk more than you're comfortable losing. Let's get into it. In Forex, you don't just buy some euros or a bit of dollars. Currencies are traded in standardized amounts called lots. Think of a lot like a standardized unit of measurement. The same way you buy eggs by the dozen, in Forex you trade currencies by the lot. There are 4 lot sizes you'll come across. A standard lot is 100,000 units. A mini lot is 10,000 units. A micro lot is 1,000 units. And a nano lot is 100 units. So when you place a trade with a standard lot on the euro versus the US dollar, you're effectively controlling 100,000 euros. Now, before you panic, you don't need 100,000 euros in your account to trade a standard lot. That's where leverage comes in, which we'll cover in its own dedicated video very soon. For now, just understand that lot size is the foundation. It determines the scale of your trade and directly determines how much money you make or lose for every pip the market moves. In the last video, we talked about pips. Now, let's connect pips to lot sizes, because this is where everything starts to click. The bigger your lot size, the more each pip is worth in real money. Here's how it breaks down for the euro versus the US dollar, approximately. A standard lot is worth about $10 per pip. A mini lot is worth about $1 per pip. A micro lot is worth about 10 cents per pip. And a nano lot is worth about 1 cent per pip. Let's make this real with some examples. Say the market moves 40 pips in your favor. With a standard lot, that's 40 times $10, which is $400 profit. With a mini lot, that's 40 times $1, which is $40 profit. With a micro lot, that's 40 times 10 cents, which is $4 profit. And the same applies to losses. A 40 pip move against you, standard lot equals $400 loss. Mini lot equals $40 loss. Micro lot equals $4 loss. This is why choosing your lot size carefully is so critical. It controls not just your potential profit, it controls your potential pain. So now we know what a lot is, and we know how lot size affects pip value. But how do you actually decide what lot size to use on any given trade? This is called position sizing, and it's the process of calculating the correct trade size based on how much of your account you're willing to risk. And I want to be very direct about this. Position sizing is not optional. It is the single most important habit you can build as a trader. More accounts are blown not because of bad strategy, but because of bad position sizing. Here's the approach that professional traders use. It's called the percentage risk model. The rule is simple. Never risk more than 1 to 2% of your account on any single trade. If you have a $1,000 account, you risk no more than $10 to $20 per trade. If you have a $5,000 account, you risk no more than $50 to $100 per trade. This might sound overly cautious, but it's what allows traders to survive losing streaks without blowing up. And every trader, no matter how good, has losing streaks. Let's walk through the position sizing calculation step by step. You'll need 3 things: your account balance, your risk percentage, we'll use 1%, and your stop loss in pips, how far the market can move against you before you exit. Here's an example. Account balance, $2,000. Risk percentage, 1%. Stop loss, 30 pips. Step 1. Calculate your dollar risk. $2,000 times 1% equals $20. This is the maximum you'll lose on this trade. Step 2. Calculate pip value needed. $20 divided by 30 pips equals approximately 67 cents per pip. Step 3. Match to lot size. 67 cents per pip is closest to a micro lot at 10 cents per pip, so you trade approximately 6 to 7 micro lots. Again, there are free position size calculators on sites like BabyPips and MyFXBook that do this instantly. But understanding the logic behind the calculation means you'll never blindly enter a trade that puts too much of your account at risk. Before we wrap up, let me flag the 3 most common lot size mistakes beginners make, so you can avoid them from day one. Mistake 1. Trading too large, too soon. This is the most common. A beginner deposits $500, opens a standard lot trade, and a 50 pip move against them wipes out their entire account. Always match your lot size to your account size and risk tolerance. Mistake 2. Using the same lot size regardless of stop loss. If your stop loss is 10 pips, a mini lot risks $10. If your stop loss is 100 pips, a mini lot risks $100. The lot size has to change depending on where your stop loss is, not the other way around. Mistake 3. Ignoring position sizing altogether. Many beginners just pick a number that feels right. This is gambling, not trading. Always calculate. Always know your risk before you click the button. The traders who last in this industry are almost never the ones with the best strategies. They're the ones with the best risk discipline. Lot sizing and position sizing are where that discipline starts. Let's bring it all together. A lot is the standardized unit for trading Forex. Standard is 100,000 units, mini is 10,000, micro is 1,000, and nano is 100. Larger lot sizes mean larger pip value, which means larger profit and loss potential. Standard lot is about $10 per pip, mini is about $1 per pip, micro is about 10 cents per pip. Position sizing is calculating the right lot size based on your account and risk tolerance. The golden rule: never risk more than 1 to 2% of your account on one trade. Use a position size calculator to make this quick and accurate every time. Stop loss size affects your position size. Always calculate together. You've now got 3 of the most fundamental building blocks of Forex trading locked in. What Forex is, what pips are, and how lot sizes and position sizing work. In the next video, we're stepping away from numbers for a moment and getting into how to actually read a candlestick chart, because before you can trade, you need to understand what you're looking at on your screen. It's one of the most visually satisfying lessons in the series, so make sure you're subscribed. If this video helped you, a like takes 2 seconds, and it helps this channel grow. And drop a comment below. What lot size are you planning to start with when you open your demo account? Let me know. I read every reply. See you in the next one. Last video, I told you this would be one of the most visually satisfying lessons in the series. Here's why. Right now, you can probably recognize a candlestick chart. Red and green blocks, little lines sticking out the top and bottom. You've seen it 100 times. But if I paused the chart right now and asked you, what is this one candle actually telling you? Could you answer? Most beginners can't. They're staring at the same information professional traders use to make decisions, and it might as well be in a different language. Not after this video. By the end, you'll be able to look at a single candle or a whole sequence of them and read the story it's telling. Who was in control, how confident they were, and where the fight is happening. Let's get into it. Before we talk about candlesticks, let's talk about why they exist at all. A line chart, the kind you'd see tracking, say, a stock's closing price over time, only shows you one piece of information, where the price ended up at the end of each period. But that hides almost everything interesting. It doesn't tell you whether the price was calm the whole time, or whether it violently spiked up, got rejected, and crashed back down before closing exactly where it started. Candlestick charts fix that. Each candle shows you 4 data points at once: where price opened, where it closed, and the highest and lowest points it touched in between. Traders have used this style of chart for centuries. It actually originated with Japanese rice traders in the 18th century, but the reason it survived is simple. It packs more useful information into one glance than almost any other chart type. Let's break one candle apart. Every candlestick has 2 main parts: the body and the wicks, sometimes called shadows. The body is the thick rectangle in the middle. It represents the range between the opening price and the closing price for that period. The wicks are the thin lines poking out above and below the body. The top wick shows the highest price reached. The bottom wick shows the lowest price reached. Now here's the part that trips people up at first: color. If the price closed higher than it opened, the candle is usually colored green or white. This is called a bullish candle. If the price closed lower than it opened, the candle is usually colored red or black. This is called a bearish candle. So just from color alone, before you even look at the size of anything, you already know which side won that round, buyers or sellers. Here's where it gets genuinely useful. The size of the body tells you about momentum. A long body means one side was firmly in control the whole period. Buyers pushed price up hard with barely any resistance, or sellers pushed it down hard. That's conviction. A small body means the opposite. Buyers and sellers fought each other to a near standstill, and price ended up almost exactly where it started. That's indecision. And the wicks tell you about rejection. A long upper wick means price tried to go higher, got rejected, and sellers pushed it back down before the period closed. A long lower wick means the reverse: price dropped, buyers stepped in, and pushed it back up. There's actually a special candle where the open and close are almost identical, so the body nearly disappears. It's called a doji, and it's one of the purest signs of indecision you'll see on a chart. We'll go much deeper on named patterns like this in a future video, but for now, just recognize it when you see it. A tiny, cross-shaped candle means neither side won. One thing that confuses total beginners: a candle isn't a fixed size. You choose what each candle represents. On a 1-minute chart, each candle shows everything that happened in that 1 minute. On an hourly chart, each candle summarizes a full hour. On a daily chart, one candle is an entire day's trading. Same market, same price data, completely different looking chart depending on the time frame you pick. Here's the practical takeaway. Higher time frames, like daily or weekly charts, show you the bigger picture, the overall trend. Lower time frames, like 1-minute or 5-minute charts, show you short-term noise, which can be useful but can also be misleading if you're not careful. Most beginners should start by getting comfortable reading higher time frames before zooming into the noisy short-term stuff. We'll cover how to actually combine multiple time frames properly later in this series. One candle tells you a moment. A sequence of candles tells you a story. A run of long bullish candles, one after another, with barely any pullback, that's a strong, confident uptrend. Buyers are firmly in control. A cluster of small candles overlapping each other, going nowhere. That's consolidation. The market is pausing, catching its breath, deciding what to do next. And here's the one that matters most for what's coming next in this series. When you see a long run of bullish candles suddenly followed by a long bearish candle that wipes out several periods of gains, that's often a sign something has changed. Momentum has shifted, and the level where that happened tends to matter a lot going forward. That idea, specific price levels that seem to matter, again and again, is exactly what we're covering in the next video: support and resistance. Reading candles is the foundation. Reading where they cluster and reverse is the next skill on top of it. Let's lock this in. A candlestick shows 4 things at once: open, high, low, and close. The body is the range between open and close. The wicks are the highest and lowest points reached. Green or white is bullish, closed higher. Red or black is bearish, closed lower. A long body means strong momentum. A small body means indecision. A doji is the extreme case. Long wicks mean rejection at that price level. Every candle represents a time frame you choose. Higher means big picture, lower means short-term noise. Read candles in sequences, not just one at a time, to see the full story. That's a candlestick chart, fully decoded. No more staring at red and green blocks wondering what they mean. In the next video, we're building directly on this: support and resistance, the invisible price levels that the market seems to respect over and over again, and exactly how to spot them on your own charts. If this clicked for you, hit like. It genuinely helps this channel reach more beginners who are stuck exactly where you were 5 minutes ago. And drop a comment below. Now that you can read a candle, which named candlestick pattern do you want me to break down first? I'm planning that video already, and I'll pick from your replies. See you in the next lesson. Last video, I promised you the invisible lines that price seems to respect again and again. Here they are. Look at this chart. Price climbs, hits this exact level and drops. Climbs again, hits it again, drops again. It's not a coincidence. It's not luck. There's an invisible ceiling sitting right there, and once you learn to see it, you'll notice it on almost every chart you look at. These invisible floors and ceilings are called support and resistance, and they're arguably the single most useful concept in all of chart reading. By the end of this video, you'll be able to spot them yourself, understand why they exist, and know what to watch for when price finally breaks through one. Let's get into it. Let's start with support. Support is a price level where a falling price tends to pause or reverse because enough buyers step in to overpower the sellers. Think of it like a floor. Price falls toward it, and instead of crashing through, it bounces. It rarely happens at one exact precise price. It's more like a zone. But the idea is simple. This is a level where demand has historically been strong enough to stop the fall. The more times price has bounced off a level without breaking through, the more traders notice it, and the stronger that support tends to become. Now flip it around. Resistance is the mirror image of support. It's a price level where a rising price tends to pause or reverse because enough sellers step in to overpower the buyers. Think of it as a ceiling. Price rises toward it, and instead of breaking through, it gets pushed back down. Same logic as before, the more times price has been rejected at that level, the more significant it becomes in traders' minds. So to summarize the two, support holds price up, resistance holds price down. Here's the question beginners always ask: why would price respect an invisible line at all? The answer comes down to collective memory and psychology. Traders remember where price reversed before. If a lot of people bought at a certain level and made money, they're often willing to buy there again if price returns. If a lot of people got burned selling at a level, they remember that too. There's also a simpler force at play: round numbers. Price levels ending in a long run of zeros act like magnets. Psychologically, humans round numbers up in their heads, and huge numbers of orders tend to cluster around them. And finally, previous swing highs and swing lows, the exact points where price has turned before, tend to be where large institutional orders sit, waiting. Put it all together and you get real, repeatable price levels, even though nobody drew them on the chart for you. Here's how to actually find these levels yourself. Look for a price point where the chart has reversed more than once. One touch could be a coincidence. 2 touches gets interesting. 3 or more, and you've very likely found a real level. For resistance, connect the swing highs, the peaks where price turned back down. For support, connect the swing lows, the troughs where price turned back up. And remember, it's a zone, not a laser-precise line. Price often pokes slightly above or below a level before reversing. Give it a little breathing room, rather than expecting a perfect bounce to the exact pip. Here's the concept that makes support and resistance genuinely powerful, not just descriptive. When a resistance level finally breaks, when price pushes through the ceiling with real conviction, that old resistance very often becomes the new support. The ceiling becomes the floor. And it works the other way too. Broken support often becomes new resistance. This is where your candlestick reading from the last video pays off. A strong, long-bodied candle that closes clearly beyond the level suggests real conviction, a genuine break. A candle that just barely wicks through the level and closes back inside is often a rejection, not a breakout, and the level is still holding. So how do traders actually use this? There are 2 main approaches. The first is trading the bounce, buying near support or selling near resistance, betting that the level holds one more time. The second is trading the breakout, entering once price convincingly pushes through a level, betting that the move continues. Both are valid, but both carry the same major risk: the false breakout, sometimes called a fake-out, where price pokes through a level just enough to trigger traders, then snaps straight back. This is exactly why we just talked about candles. Don't react to a single wick poking through a line. Wait for a close beyond the level, ideally with a strong-bodied candle, before you treat it as real. Let's lock this in. Support is a price floor where buyers tend to step in. Resistance is a price ceiling where sellers tend to step in. These levels exist because of trader psychology, round numbers, and memory of past price action. Look for multiple touches at a similar price. The more touches, the stronger the level. It's a zone, not a single exact price. Broken resistance often becomes new support, and broken support often becomes new resistance. Watch the candle at the level. A strong close through it suggests a real breakout. A bare wick suggests rejection. Two main approaches: trade the bounce or trade the breakout, but always wait for confirmation. You can now read a candle and spot the exact levels on a chart that matter most. Genuinely, that's enough to start looking at charts the way a trader does. In the next video, we're stepping away from chart theory for a moment and getting practical: how to choose a Forex broker, what actually matters when picking one, and what to avoid before you open any kind of account. If this video helped connect the dots, hit like. It genuinely helps this channel reach more beginners working through the series. And drop a comment below. Go find a support or resistance level on a chart right now. Which pair did you check, and what did you find? I'd love to see what you spot. See you in the next lesson. You've made it through 5 videos. You understand Forex, pips, lot sizes, candlesticks, and support and resistance. So now you're ready to actually practice, which means you need somewhere to do it. You open a search engine, type Forex broker, and immediately drown in 100 ads, all claiming to be the best, the tightest spreads, the fastest execution. Here's the problem. This is the one decision in this entire series where a bad choice can cost you money before you've even placed a trade. Choosing a broker isn't like choosing a streaming service. Your money actually sits with this company. So today, we're cutting through the noise. By the end of this video, you'll know exactly what actually matters when picking a broker and what to run from. Let's get into it. Before anything else, before spreads, before platforms, before bonuses, there is one factor that matters more than all the others combined: regulation. A regulated broker is overseen by a financial authority that sets rules around how client money is handled. Depending where you live, you'll see names like the FCA in the UK, ASIC in Australia, the NFA and CFTC in the US, or SISEC in Europe. Regulation matters for one huge reason: segregated client funds. A properly regulated broker is legally required to keep your money in accounts separate from the company's own operating funds. If the broker ever runs into financial trouble, your deposit isn't just sitting in their general business account, exposed to their debts. Before you look at anything else a broker offers, check who regulates them and verify it directly on the regulator's own official website, not just the broker's marketing page. Once regulation checks out, the next thing that actually affects your bottom line is cost. Most brokers make money through the spread, the small difference between the buy price and the sell price of a currency pair. Some brokers instead charge a separate commission per trade, usually alongside a smaller spread. Neither model is automatically better, but the numbers matter. A broker with consistently wide spreads on major pairs is quietly taking a bigger cut of every single trade you make, win or lose. For a beginner, look for tight, consistent spreads on major pairs, like the ones we covered back in video 1, and always check whether spreads widen dramatically during news events. Some brokers' costs balloon exactly when the market gets active. Remember lot sizes from a couple of videos ago. This is where they connect directly to your broker choice. Most brokers offer different account tiers, sometimes requiring a minimum deposit that can range from nothing at all to several $1,000s. As a beginner, you want a broker that supports micro lots, or even better, fractional position sizing, because that lets you trade with genuinely small, low-risk amounts while you're still learning. A broker that only supports large minimum trade sizes forces you into more risk than you may be ready for. Look for low minimum deposits and confirm the smallest lot size they actually allow before you commit to anything. Next, the platform itself, because this is the software you'll be staring at every time you trade. Many brokers support well-known third-party platforms like MetaTrader 4 or 5, which are widely trusted, well-documented, and consistent across different brokers. Others build their own proprietary platform, which can be perfectly fine too, but is worth trying before you commit. Check for a few practical things. Does it have solid charting tools so you can actually apply what you learned about candlesticks and support and resistance? Is there a mobile app if you want to check positions on the go? And, importantly, does the broker offer a way to test the platform before funding a live account? A platform that feels clunky or confusing will slow down your learning far more than it should. Here's a category beginners almost never think to check until it becomes a problem. How easy is it to actually get your money out? Deposits are always effortless. Brokers want your money in. Withdrawals are the real test of a broker's legitimacy. Read reviews specifically about withdrawal times and any hidden fees attached to taking your own money out. Also, check what customer support actually looks like. Is there live chat, phone support, or just a contact form that disappears into a void? You want a broker you can actually reach if something goes wrong with your account. Let's close with the red flags that should make you walk away immediately. Guaranteed profits or risk-free trading. No legitimate broker or signal provider can promise this. Forex trading always carries risk, full stop. Unregulated offshore brokers with no verifiable license, especially ones pushing extremely high leverage as a selling point rather than a risk. Pressure to deposit more money, especially from a personal account manager who contacts you directly. This is a classic pattern in Forex scams targeting beginners specifically. And finally, difficulty withdrawing funds, or a support team that goes quiet the moment you ask for a withdrawal. If you ever experience this, treat it as a serious warning sign, not a technical glitch. Let's lock this in. Regulation first, verify it directly with the regulator, not just the broker's website. Segregated client funds protect your money if the broker runs into trouble. Compare spreads and commissions, costs quietly eat into every trade. Choose a broker that supports small lot sizes and low minimum deposits. Check the platform, charting tools, mobile app, and a way to try before you fund. Research withdrawal speed and real customer support quality. Red flags, guaranteed profits, unregulated offshore brokers, pressure to deposit more, and slow withdrawals. That's exactly what to check and exactly what to avoid before you open any kind of trading account. In the next video, we're getting hands-on, how to set up a demo account step by step so you can start applying everything from this series with zero financial risk while you build real skill. If this video helped you avoid a bad decision, hit like. It genuinely helps more beginners see this before they make a costly mistake. And drop a comment below. Have you already picked a broker? Or are you still comparing options? Let me know where you're at. See you in the next lesson. You've picked a broker, or you're close to it. Everything else in this series, pips, lot sizes, candlesticks, support and resistance, has been building toward one moment, actually placing a trade. But you're not going to risk real money to do that. Not yet, and honestly, not for a while. That's exactly what a demo account is for. And today, we're setting one up properly, the way it's actually meant to be used, not just clicked through and forgotten. Let's get into it. A demo account is a practice trading account that uses fake money but real live market prices. That distinction matters. You're not trading against some simplified simulation. You're seeing the exact same price movements, the exact same spreads, and usually the exact same platform that live traders are using at that exact moment. The only thing that isn't real is the money, which means you can place trades, get them wrong, get them right, and watch exactly what happens without a single cent of actual risk. For everything we've covered in this series so far, this is where it stops being theory. Here's the good news. Almost every regulated broker, the kind we talked about in the last video, offers a free demo account, and it takes a few minutes. Step 1. Go to the broker's website and look for demo account or practice account, usually right next to the live account sign up. Step 2. Register with just an email. Most demo accounts require no deposit and no verification documents. If a demo account is asking for ID or payment details, that's worth being suspicious of. Step 3. Once you're in, you'll usually be dropped straight into the same platform we talked about last video, MetaTrader or the broker's own interface, fully loaded with a starting practice balance. That's it. You now have a live-priced, zero-risk trading environment. The setup was the easy part. How you use it is what actually matters. Here's a mistake almost every beginner makes without realizing it. They leave the default demo balance exactly as it is, often something like $10,000 or even $100,000. The problem? If you're realistically planning to start live trading with $300 or $500, practicing on a $100,000 balance teaches you completely the wrong instincts. A $50 loss feels irrelevant on a $100,000 balance. That same $50 loss is a genuinely meaningful risk decision on a $500 account. Most brokers let you adjust your demo balance. Set it to match what you'd realistically deposit for real. This is one small step that makes your practice far more honest. A demo account is wasted if you just click buy a few times and close the app. Here's what to actually work on. Practice calculating your position size properly, the way we covered a couple of videos back. Don't just guess a lot size. Do the maths every single time until it becomes automatic. Practice spotting support and resistance on real, live charts and watch what candles actually do when price reaches those levels. Theory versus what genuinely happens are two different things, and a demo account is where you close that gap. And critically, practice using a stop loss on every single trade. Not sometimes, every time. If that habit isn't automatic by the time you go live, it never will be. There's no magic number here, but there is a wrong answer. A few days is not enough. The market moves differently week to week. A handful of lucky trades over 3 days tells you almost nothing about whether your approach actually works. A more honest benchmark, aim for consistent, disciplined execution over several weeks, not necessarily consistent profit yet, but consistent process. Are you calculating position size every time, using a stop loss every time, following your own plan instead of reacting emotionally? If yes, you're building the right habits. If you can't do that on a demo account with zero real risk, going live won't fix it. Here's the part almost nobody warns beginners about. Demo trading and live trading are not emotionally the same. It is much easier to follow your rules perfectly when there's nothing real on the line. No fear, no excitement, no urge to move your stop loss because you're nervous. Real money changes your decision-making in ways a demo account simply cannot simulate. So use your demo account for exactly what it's good for. Building mechanical skill, calculations, chart reading, execution. Just don't mistake demo confidence for live money readiness. We'll go deep on the psychology side later in this series because it genuinely deserves its own conversation. Let's lock this in. A demo account uses fake money, but real, live prices. Setup takes minutes, no deposit, no documents required for most brokers. Set your demo balance to match what you'd realistically deposit for real. Practice position sizing, spotting support and resistance, and using a stop loss every time. Demo trade for weeks, not days. Focus on consistent process, not just profit. Demo trading builds mechanical skill, not emotional readiness. The two are genuinely different. That's how to set up and actually use a demo account properly. In the next video, we're adding another tool to your chart reading skill set, trend lines, and how to use them alongside the support and resistance you already know. If this video helped you get started the right way, hit like. It genuinely helps this channel reach more beginners at exactly this stage. And drop a comment below. Have you opened your demo account yet? What balance did you set it to? Let me know. See you in the next lesson. You already know how to spot support and resistance, the flat horizontal levels where price tends to react. But price doesn't only move sideways between levels, it trends, and when it does, the flat lines from the last video stop being enough. That's where trend lines come in, the tool that turns a random-looking chart into something with actual structure. Let's draw some. A trend line is just a straight line connecting a series of swing points, the points where price clearly turned. In an uptrend, you connect the swing lows, the bottoms of each pullback. In a downtrend, you connect the swing highs, the tops of each rally. That's genuinely it. It's the same idea as support and resistance, except instead of a flat level, the level is moving, sloping up or down along with the trend. The line itself isn't magic. It's just a visual summary of the angle the market is currently respecting. Here's how to actually draw one. Find two swing lows where price pulled back and then turned higher. Connect them with a straight line. Once you have those 2 points, extend the line out to the right. That extension is your trend line doing its job, a rough guide for where the next pullback might find support. One important detail: use the most obvious swing lows, not just any two random dips. If you have to squint or force the line to fit, you've probably picked the wrong points. A good uptrend line usually touches a third low later on, roughly where you'd expect. When that happens, it stops being a guess and starts being a genuine level traders are watching. A downtrend line works exactly the same way, just flipped. Find two swing highs, points where a rally stalled and reversed lower, and connect them. Extend that line to the right, and it becomes your rough guide for where the next rally might run out of steam. Same rule applies. Use the clearest highs, not ones you had to force. And the same third touch idea holds. A downtrend line that gets respected a second and third time is far more meaningful than one drawn from a single pair of points. Here's something that trips up almost every beginner. 2 points can always be connected with a straight line. That's just geometry. It doesn't prove anything about the market. A trend line only becomes meaningful once price touches it a third time and reacts. That third touch is what tells you other traders are watching the same line you are. So treat a 2-point line as a hypothesis, not a fact. Wait for that third touch before you start making decisions based on it. This single habit will save you from drawing lines that look convincing but mean nothing. When price finally closes through a trend line, that's a signal the current trend may be losing strength. It's not an automatic reversal, it's a change in the angle traders were relying on. Often, after a break, price will come back and retest that same line from the other side, treating former support as new resistance and former resistance as new support. That retest is often a more reliable moment than the break itself. The break tells you something changed. The retest tells you whether the market agrees. The biggest mistake is forcing a line through price just because it would look neat, rather than drawing it from genuinely obvious swing points. The second mistake is switching between wicks and candle bodies halfway through. Pick one, wicks or bodies, and stay consistent for that entire line. And the third mistake is drawing 5 or 6 trend lines on one chart. If you need that many lines to make sense of the price action, you're overcomplicating it. 2 or 3 clear lines will always tell you more than a tangle of 10. Let's lock this in. Uptrend lines connect swing lows. Downtrend lines connect swing highs. 2 points make a line, but 3 touches make it meaningful. A break signals change, but the retest often matters more. Stay consistent, wicks or bodies, not both. 2 or 3 clear lines beat a chart full of forced ones. Combine trend lines with the support and resistance you already know. That's trend lines, a simple tool that adds real structure to any chart you look at. In the next video, we're putting everything from this series together and actually placing your first trade the moment this whole series has been building toward. If trend lines just made your charts make more sense, hit like. It genuinely helps this channel reach more beginners. And drop a comment below. Which pair are you practicing trend lines on right now? Let me know. See you in the next lesson. Pips, lot sizes, candlesticks, support and resistance, trend lines, 8 videos of building blocks, all pointing at one moment. Actually placing a trade. Not clicking randomly on a demo account, placing a trade with an actual reason behind every field on the screen. Let's walk through it, piece by piece. Before you touch the trade ticket at all, 3 questions need answers. What's your reason? A bounce off support, a trend line holding, a clean setup, not a gut feeling. What's your position size? The lot size math from earlier in this series, based on what you're actually willing to lose. And where's your stop loss going? Decide that before you open the ticket, not after. If you can't answer all 3, you're not ready to click anything yet. Every trade ticket has the same core pieces, a buy button and a sell button. Buy if you think price is going up, sell if you think it's going down. A lot size field, where you enter the position size you already calculated, and 2 prices sitting side by side, the price you can sell at and the slightly higher price you can buy at. That gap between them is the spread you learned about back in video 6. Everything else on that screen is secondary. Those three things, direction, size, and the spread you're paying, are what actually matter before you go further. Your stop loss is not optional. It's the price where you're proven wrong and the trade closes automatically to protect you. Place it based on the chart, not on how much money you're comfortable losing. If you're buying because support held, your stop loss belongs just beyond that support, the point where your original reason for the trade stops being true. A stop loss placed for chart reasons might still get hit. That's fine. It means the setup failed, not that you did something wrong. A stop loss placed just to feel comfortable protects nothing. Your take profit is where you plan to close the trade for a win. A logical target is the next support or resistance level in the direction you're trading. Compare that distance to your stop loss distance. If your stop loss is 100 pips away and your take profit is only 50, you're risking 2 to win 1, a trade that's tough to profit from, even if you're right often. Beginners should look for setups where the potential reward is at least equal to the risk, ideally larger. If the reward doesn't justify the risk, it's not a setup worth taking, no matter how confident you feel. A market order fills immediately, at whatever the current price happens to be. Use it when the setup is happening right now and you don't want to wait. A pending order sits and waits until price reaches a specific level you choose, then fills automatically. Useful when your setup depends on price first reaching a certain level, like a trend line or a support zone. Neither type is better. A market order suits a trade that's already valid. A pending order suits a trade that will only become valid once price gets somewhere specific. Once the trade is placed, it becomes an open position, and you'll see something called floating profit and loss, the running total of what you'd gain or lose if you closed right now. It moves constantly, and that's completely normal. It isn't the final result, it's just where the trade currently stands. Resist the urge to close early just because that number turns slightly negative for a moment. You already decided your stop loss and take profit before you clicked buy. Trust the plan you already made and let the trade play out to one or the other. Let's lock this in. Know your reason, size, and stop loss before opening the ticket. Direction, lot size, and spread are what matter on the trade ticket. Stop loss goes where your reason for the trade would be proven wrong. Take profit should offer a reward at least equal to your risk. Market orders fill now, pending orders wait for a price. Floating profit and loss moves constantly. Trust your original plan. That's how to place a trade with an actual reason behind it, not a guess, a plan. In the next video, we're covering something just as important as any chart pattern, trading psychology, and why your mindset decides more outcomes than your strategy does. If this made your first trade feel less intimidating, hit like. It genuinely helps this channel reach more beginners. And drop a comment below. Did you place a demo trade using this process? Let me know how it went. See you in the next lesson. Back in the demo account video, I promised we'd go deep on trading psychology later in this series. This is that video. Because here's the uncomfortable truth. You can know every pip calculation, every candlestick pattern, every support and resistance level in this entire series, and still lose money, not because your analysis was wrong, but because of what happens in your head the moment real money is on the line. Let's talk about it properly. Two traders can look at the exact same setup, take the exact same trade, and get completely different results. Not because the market treated them differently, because they behaved differently once they were in it. One follows the stop loss and take profit they already decided on. The other moves their stop loss, closes early out of nerves, or adds to a losing position hoping it turns around. The strategy was identical. The outcome wasn't. That gap is entirely psychology. And it's the reason most beginners don't fail from a lack of knowledge. They fail from not managing themselves. Almost every emotional trading mistake traces back to one of two forces. Fear, closing a winning trade too early because you're scared of losing the profit you already have. Greed, staying in a winning trade far past your target because you want more, or risking too much because you're chasing a bigger win. Fear cuts your winners short. Greed lets your losers run and your risk grow. Notice both are about your reaction to the trade, not about the chart itself. Revenge trading happens after a loss, when you open a new trade almost immediately, often bigger than your normal size, trying to win back what you just lost. It rarely works, because that new trade wasn't based on a setup. It was based on emotion, and the position size is often reckless precisely because you're trying to fix a feeling, not follow a plan. The fix is almost mechanically simple. After a loss, step away before you place another trade. Not forever, just long enough to confirm your next entry is based on the chart, not on frustration. A win streak feels like proof you've figured it out. That feeling is exactly when position sizes tend to creep up, stop losses get skipped just this once, and setups get looser because everything's been working. One oversized loss during an overconfident streak can erase several careful wins. The math of risk management doesn't stop applying just because your last few trades went well. Consistency, not a hot streak, is what separates a trader from someone who got lucky for a few weeks. Keep the same rules on trade 10 as you did on trade 1. FOMO, the fear of missing out, is what happens when you see price moving fast without you in the trade, and you jump in purely because it's moving, not because you had a setup. By definition, you're entering after the move has already happened, with no support level, no trend line, no plan for where you're wrong. It's the opposite of everything covered in this series. If you can't explain your reason for a trade in one sentence using the tools from this series, it's FOMO, not a setup, and the trade ticket should stay closed. Every technique in this series, reading candles, drawing trend lines, setting a stop loss, only works if you actually follow it once the trade is live. Discipline is doing that even when it's uncomfortable. That's the entire reason a demo account matters. Building the habit of sticking to your plan while there's zero financial pressure, so it's already automatic by the time real money is involved. Discipline isn't a personality trait some traders are born with. It's a habit built one trade at a time, and every trade where you follow your plan anyway makes the next one easier. Let's lock this in. Identical strategies can get different results. Psychology is the gap. Fear cuts winners short. Greed lets losers run. After a loss, step away before the next trade. A win streak doesn't excuse skipping your rules. No one-sentence reason means it's FOMO, not a setup. Discipline is a habit, built one trade at a time. And that's Season 1 of the Trading Ledger, from what Forex trading actually is, all the way to the psychology behind every trade you'll ever place. If you've made it through this whole series, you genuinely know more than most people who jump into trading blind. Go build on it, on a demo account, at your own pace. If this series helped you, hit like and subscribe. It tells me exactly what to build more of next. And drop a comment below. Which video in this series helped you the most? I read every one. See you in the next video.